Hello and welcome, Peter Smelt Services Point of View. Today is Tuesday, March the 1st. So the Ides of March, here we are. I wanted to welcome you all to our video and thank you for watching. We're going to go over a few topics today. I think it's timely about the Russia situation, and we wanted to provide some insight on what we're thinking and what we're going to do about it, hopefully. So currently the market is sitting at about an 8% drop with the Dow, for the year to date. And we're also looking at S&P down about 9%. The NASDAQ has, tech-heavy NASDAQ is a little bit further selling pressure and seen about a 12.5% decline. So some of these things have been on edge. People have kind of gotten a little bit more upset and nervous of late. We haven't seen a correction for quite some time, but now we're in one. Oil prices, on the other hand, have been up 24%. So we're seeing that spike, and that has a direct impact, obviously, with the Russia-Ukraine situation. We're going to show you some charts on the market corrections during other major wars and the subsequent return, so the long-term view of it, a long-term chart, if you will. And then we'll talk a little bit about the economic impact in our own country from the fallout over there and what may come about, and how our own Federal Reserve is positioning now, some of the changes that are going on with the landscape of interest rates. So Shaun is going to talk a little bit about maybe some of the other world wars we've seen.
Yeah, definitely wild times. And if you've watched our videos, you know that we've been calling for a market correction. We felt like it was going to be a healthy correction, and here we are. We're right in the midst of it. So when we look at corrections, it's always nice to see, okay, yes, we've corrected, but what happens after? That's what people are always worried about. They're worried about their financial future, their investments, their retirement. And so if you look at it, our friends from First Trust have a really nice chart here with stock market corrections and subsequent year returns. So if you go across here, you can see in the light blue, it shows you the 1 year after a market correction, and then the dark blue, going a little bit further out, 2 years after a market correction. Then on the right side of this chart shows all of these different corrections dates. So as you can see, it's very common to have corrections. And I'm not going to go through every single one of these, but at the bottom it kind of summarizes, all right, what was the average correction? Around 18.5%. What was the average 1 year return, and then the average 2 year return? And I like to look at the very bottom where percentage positive. So 90% of the time, 1 year after a correction, the market has a positive return, which is powerful. After 2 years, 87% of the time, the market is in positive territory again. So again, we're always focusing on what you do during these corrections is what really matters. Believe me, we are thinking about what to do every single day with our models, with our portfolios. We have made some adjustments through this, but cashing out or selling or, hey, I want to wait this out, I want to move to the sidelines is usually not the right thing to do during these periods. It's stay in the boat, make adjustments to your course to get through the storm. Another great chart that I like to look at, more focused on what we're seeing today, is U.S. stock market return during major wars. So this highlights about 5 different wars that we've gone through. Blue is the annualized return during that wartime period, okay? If you look at the small print down there, it'll tell you what years we're looking at for each war. And then the orange is standard deviation, which is just a measure of volatility. And again, further on the right there, highlighted in gray, it's long term. So market returns from 1926 to 1921. So what we're saying here, don't focus on the short-term, day-to-day stuff. We have to always bring it back to long term. And I know that sounds like a broken record, and sometimes people think, oh, you just say that to say that. No, we say that because we study it and we've been through this, and we are long-term investors. We're not day traders. So important to look at that. And I think Billy's got some comments on some more war times too.
And longer term. So the next chart we'll show you is the wartime in the stock market over a long period of time. So this dates back clear to 1928. So we're almost 100 years worth of data here. And look at the chart of basically the S&P 500 index, and it's climbing, as you see, not in a straight line, but it's going to have some volatility during all these events. So, count up how many wars we've lived through in history, just in the last 100 years. And, in every case, of course, there was reason to doubt, reason to maybe sell holdings, doubt what you were doing with your investment dollars. But the markets continue to plow higher. So to believe that it's time to sell because we're in a conflict and get out and never get back in, I think is foolish. Just look at some of these major conflicts. Next chart popping up on your screen now is the major events, geopolitical shocks, let's call it, how far they sold off during that period, and then how many days it took to recover. So you can see the different event dates from the Russian invasion right now we're dealing with to go down to Iraq invasion of Kuwait, and maybe all the way down to the bottom, the Pearl Harbor attack, which most of us would agree that was probably the most significant event over the last 100 years. Initiated World War II, and how devastating that was, how many casualties, how many deaths, the economic collapse and fallout from that. You see the one-day return, the one-year return was a positive. The max drawdown on that particular event from that date was about a 20% decline. The days until bottom, 142 days. So, half a year, not even half a year we're talking about, and then the days until recovery. So it took 304 days to get back to that high, but it still, of course, goes back to the high. And that's what we're always preaching, is the markets don't just go down and stay down. They recover. So find some fresh dollars if you can and try to invest while markets are giving us an opportunity. Just to go back and summarize some of the things that we're talking about today, we want to share with you just our thoughts on what's happening around the world, and specifically Russia, and how it's affecting us here at home.
Yeah, it's definitely scary times, like I mentioned before. With this Russia thing, we're dependent on oil from Russia. I mean, there's no getting around that. We really are, and we've become more dependent on their oil in recent years. So I know that there is a big push towards green energy, and who wouldn't want green energy? Everybody would like to have that. I think it's trending that way. But from what we've listened to, what we've studied, the infrastructure is not there yet. We're not ready for that. So you're seeing politicians push that, and it's great, but we're not quite there yet. And now we're relying on foreign oil, which is now definitely, with this war going on, you're going to see rise in price at the pumps.
Huge.
And if we could flip the switch and become energy independent right now, I think that would be a huge move. It'd be something that I know we would definitely agree with, and some wouldn't, and that's okay. But we're trying to look at this as inflation is running at 9%, probably even higher. I think it's being underreported right now. Your food prices are going up. Everything commodity based is going up, and that's what we've been adding to our portfolios over the last 6 months. We've been adding commodities. We've been de-risking by taking back on some of our growth, some of our technology holdings. We still own them, but we've taken some profits off the table. We've de-risked by getting out of our smaller caps, so smaller companies that are more reliant on lending and debt. We're seeing rising interest rates. That's going to happen. The reports out there, the Fed is going to raise rates. It's going to happen. Before this, you were seeing maybe an average call of maybe 6. Would you say rate hikes a year?
6.5, I think was priced in.
Yeah, now future markets, they've got it more like around 4, and probably minor hikes, because they don't want to slow the economy too much. They don't want to put the brakes on and everyone goes through the windshield.
That's the positive of this. I mean, if you can find a positive in this situation, is the Fed's now gone a little more dovish than they were, especially just with this Russia situation, the uncertainty it's caused.
Yeah.
So maybe not as many rate hikes for us here in the 2022 year.
Yep. I think we need to go into this as a country. We need to have a strong front into this. We need to be prepared to say no more. No more from Russia. We're bringing a lot of production back here. We can handle this. I mean, before we were exporting oil, and now we're relying on it too much. And I think that kind of winds back to the first point we were making, is trying to bring this back to our own country, and make those that are doing wrong things, make them suffer.
It's a matter of, are we weaker or are we stronger?
Right.
And we're relying on someone else, we're weaker. I mean, it's no getting around that. We are importing 600,000 barrels of oil a day from Russia. And think about that. It's billions of dollars a month at this price, and the prices are going up. We're up 5% on oil today, reaching a high of 105, and a lot of economists and analysts are thinking it's going to 130, maybe even 140. Who knows? If this conflict drags out, I think oil prices continue to go up, continue to rise. So that tonight is a State of the Union address, and I think President Biden really needs to come up with an answer to this, because to continue to push the narrative that we're going to force ourselves into green energy, just as Shaun mentioned, we're not ready for it. It's going to be decades before we're ready for that. We cannot support our economy with green energy yet. there's too much going on. We're subsidizing it. So taxpayer money is going toward these companies, these industries, the infrastructure. They're not even cash flow positive, not even close.
So what he's saying by that, if that subsidy wasn't there, those companies would not exist.
They would be out of business.
Yeah.
And they're not subsidizing oil companies. Now, we all understand fossil fuels, and everybody's trying to get their grip around clean environment, water, air. U.S. is far cleaner air and water than any of the other major developed countries. Far cleaner. So here we are saying we're not going to tap into our own natural resources, but we'll allow Russia to. To me, it just doesn't make sense. We're going to then import it from Russia, allow them to tap into their own resources and make money on us. Anyway, that's just another one. We could go on for hours about that, but you guys get the point. I think what we're trying to say is we need to become more energy independent ourselves until we're ready for that switch into solar and electric cars. And heck, I own one, so I'm not anti that. But it's being ready to do it, not being forced into it with politicians who just flap their jaws. So pay attention to what you're hearing on the media and kind of do some of your own analysis.
Pay attention to the media, but also vet your sources.
Please.
Don't just watch one. Watch them all and try to interpret it all, because it's definitely hard. I mean, you're seeing stuff come out all the time that hey, that was not right.
Not true.
It's not true, and you were sure as heck that it was true, and it happens. So, and like we said in our email last week, it's good to be informed, but it can be detrimental to be glued to this all day. You can drive yourself absolutely nuts, and there's no need to have sleepless nights over this type of stuff. So
exactly.
Going forward, we're actually positive on the markets.
We're pretty actually bullish from here. At this point, we're like close to a 9% decline in the S&P, and we think we're going to end the year closer to a 20% increase from here. So I think new money right here could do very well. I think this conflict eventually fades away, kind of like COVID. It'll fade away. It'll be behind us. And Russia could ultimately win this very easily. They're just too strong for Ukraine. But Ukraine's putting up a strong front. Let's just face it. And the whole world, I think, is united against Russia.
Yeah.
So Putin's going to lose a lot of friends and a lot of support from just society in general. His own country is.
He lost his black belt this morning.
Is that right?
They took it away. They took his black belt away.
I mean, that's a pretty devastating loss right there. It's probably tough as the sanctions we put on. The sanctions actually are pretty strong sanctions. And so financially, it's really going to hurt him. How far he wants to push this. If he loses some of his support from the oligarchs there that's been tied in with him for all these decades, think about it. Their stock market is closed, and they're not planning to open it till March 5th. These folks over there are just like us. They have money invested in it. They want to see the opportunities created and make money. They're closed. Their stock market dropped 50%, and they closed it.
Yep.
Their ruble is down 50% against the U.S. dollar. Think about how hard that and devastating that is for the people there in the country who are trying to purchase things.
Yeah.
So it's not going good. He could take it over, yes, but he's going to lose a lot. And I don't know if now is he going to decide if he's going to save face, to escalate it. If he goes nuclear, then our predictions about the future for this year, we're going to come back and revisit.
Or goes after a NATO country, then that changes everything.
So we're watching it all closely. I know you guys are as well. This is a developing story. We feel like they're trying to negotiate. They're already talking about, they're meeting, they're negotiating. We think Putin's trying to de-escalate, but he wants to win out. He ultimately wants to bring Ukraine back into his fold. He felt like he lost it. He doesn't like NATO countries having such a strong presence in Ukraine. Mm-hmm. He doesn't want them to join the EU. You can kind of understand that. If China were to come into Mexico and start taking up a presence, U.S. would not like that. So get the whole political landscape and the idea of what they're trying to do each side. We're not in favor of how he's going about it at all.
Not at all.
But we are where we're at, and hopefully this is an opportunity. We're all going to take advantage of it. End of the year, we're much higher than we are now.
Yep.
So thanks for staying tuned to us in this long video today, and we hope you have a good day. Call us if you have any questions.
Thank you.